Hello, I'm Consuelo Mack, and welcome to this WealthTrack retirement planning segment with Christine Benz, who is Morningstar's Director of Personal Finance and a frequent WealthTrack guest. And Christine has spent much of her career helping individuals plan for a more secure retirement and helping retirees live one as well. So, Christine, thanks so much for joining us once again on WealthTrack.
Consuelo, it's great to be here.
You know, you have written numerous pieces on what is called the bucket approach to retirement, and that approach was pioneered by another WealthTrack guest, financial planning guru Harold Evensky. Describe why you think the bucket approach to retirement is so important in today's financial climate, and essentially what the bucket approach to retirement means to you. First of all, give us a good definition.
Sure. The basic idea and the way Harold Evensky thinks about it is that in addition to that long-term part of your portfolio that consists of stocks and bonds, you need to have some near-term living expenses set aside when you're retired, and you need to have that money in cash. You can't afford to see it swing around in value because that'll affect your quality of life. So his basic idea was that, retirees need to have some safe money set aside in cash, and then the long-term portfolio is going to do what it's going to do, and you won't have to worry too much. You'll know that you'll have 1 or possibly 2 years worth of living expenses that is not going to fluctuate. Your quality of life is insured at least for those couple of years. So that's the central idea, and I think it's particularly relevant right now, in part because we've seen yields go down. Yields on bonds, yields on stocks have gone down. And so a lot of retirees who had been trying to live off whatever yield their portfolios kicked off have been very challenged. So the idea is that we manage these long-term assets really for total return, and then we periodically replenish that first bucket, that cash bucket, with the proceeds from the total return portfolio. That's the central idea.
Explain to me, you described basically cash as dead money in one of your articles about the bucket approach. So explain to me, how we should treat cash and how distressing it is for so many individual investors to actually see a portfolio that really is yielding nothing if you're investing a year's worth of living expenses in that bucket one.
Right. So that cash provides a lot of peace of mind. That is the central idea of having it as part of your investment plan in retirement. But you definitely don't want to have too much in cash because, as you say, there's a huge opportunity cost. We've seen great returns from the stock market over the past 5 years, semi-decent returns from bonds, but cash really hasn't been very productive. So you don't want to forsake too much for peace of mind. You want to keep this bucket number one, the cash bucket, limited to 1 to 2 years worth of living expenses. Any more than that, you've got too great an opportunity cost.
And I guess the point is that you tell me how you treat that bucket one. Is it that you only use that bucket in an emergency, for instance, or do you expect to continuously use that first year of living expenses and replenish it on a yearly basis? How does that work?
Well, you're right. The logistics of this can be a little complicated, but you want to try to keep it simple. The idea is that you are spending bucket one, so that's your spending money for years 1 and 2 of retirement.
Right.
Replenishing that bucket one is really a matter of personal opinion. The strategy I would use is kind of a strict buy, hold, and rebalance strategy, so you're reinvesting all your dividends, you're reinvesting your capital gains, and then you're periodically rebalancing that portfolio. Say you're looking at it right now and you say, well, my stock portion has been pretty good. I'm going to take some of my winnings and plow that into replenishing bucket one. There may be other market environments where bonds perform relatively better, and that's where you pull your money. So the idea is that you've got a little bit of a cushion in bucket one, but you do have to periodically refill it. And I would say every year or so is just fine. You don't need to replenish it on a monthly basis. You don't want to make it more complicated than it really needs to be.
So talk to us about bucket two and beyond. And bucket two is what you look at it as a 5-year term, essentially?
Right. And again, this piece of the pie can be customized based on the investor's own risk preferences. But in the model portfolios that I've done, I've typically thought of this bucket number 2 as being for the next 5 to 7 years of retirement. And it is taking a little bit more risk. So this is owning some short-term bonds, some high-quality intermediate-term bonds. You might even own a little bit of a sort of a moderate allocation or balanced fund as this portion of the portfolio. The idea is that you want to take a little bit more risk, but in case bucket 1 runs dry, your cash is all gone, and it's not a good time to tap stocks to refill bucket 1, you want to be able to potentially take some money out of bucket 2. So you can't take too much risk with this piece of the portfolio.
And again, it sounds like you're either taking away the capital gains or dividends, possibly to replenish bucket 1 on a yearly basis or every 2 years. And for bucket 2, you're also planning to use bucket 2 again for retirement expenses, right? So you're drawing from that portfolio as well, or how does that work?
Well, you could, and this is another thing that one could do in terms of maintaining these buckets. One could spill any income and dividend distributions and capital gain distributions, just have them automatically sent to bucket number 1. And incidentally, this is a strategy that I know a lot of our Morningstar.com users use. They don't like this idea of just using a total return portfolio and periodically rebalancing it. They want to be in show me the money mode. And so to do that, you are paying those dividend income and capital gains distributions directly into bucket 1. That's another strategy that one could use to keep this whole thing working.
So that really takes away when you talk about stocks, for instance, and any investments, it's the reinvestment of dividends and interest that provide a large portion, up to 40% in stocks, for instance, of the return of stocks over time. So in fact, that you really are depending for growth in bucket 1, there is no growth because it's cash right now, and right. there is no interest on cash. Right. But for bucket 2, for instance, there could possibly be capital gains as well as interest. So you're foregoing the total return, the reinvestment aspect of the total return of investments in bucket 2 as well.
If your strategy is to spend those distributions as they occur, that's absolutely right, that you would be forsaking a part of your total return. That's one reason I do like the idea of reinvesting those distributions and instead using rebalancing proceeds to refill bucket 1. I think it will tend to, over time, generate a better long-term return for that portfolio than would be the case where the income distributions are spent right away.
All right, that's a very good point to bring up. So talk to us about bucket 3, which is where most of us spend our time agonizing over. Right. Is our long-term portfolio providing us with income and growth?
Exactly. So this is primarily the stock portion of a portfolio. Retirees absolutely need stocks as part of their portfolio. So in the construct we discussed, you've got bucket 1, that's cash, that's years 1 and 2 worth of living expenses. Bucket 2 is maybe the next 5 to 7 years. Bucket 3, the stock piece, is for everything else. And I think the surprising thing is when retirees run through this exercise and look at their own portfolios, they might find that they actually should have more in stocks than they actually do have. So this is kind of a rational way for assessing your asset allocation. You're looking at your spending needs from that portfolio and backing into the asset allocation.
And when we talk about long terms, and we're talking about divvying up these 3 buckets, what portion of one's retirement assets should be in each bucket? Do you have a sense? I mean, how do you figure that out?
Well, it really comes down to your spending needs. And so This is kind of interesting. I often run into people, well, less these days, but run into people who say, well, the pension plus maybe Social Security that my spouse is getting, that's 90% of our income right there. And so if they look at this strategy, they're really sipping from their portfolio. For someone like that, that means bucket one is pretty small because their spending needs are limited. Bucket two is also not huge. Most of their portfolio belongs in stocks, actually,
right.
Given that so much of their income is being replaced by the pension and Social Security. For other folks, they come into retirement, they don't have a pension, they're looking at Social Security, but that portfolio is having to step up and supply that much more of their living expenses. In that case, that would argue for a more balanced portfolio because you are spending that money in bucket one, you're spending a lot of your portfolio, and bucket two as well. So it really depends on how much of your anticipated income needs are going to be covered by those certain sources of income like Social Security and pension.
And Christine, does this approach work over, we talk about the long term, so I'm thinking of, let's say you are going into a retirement, so you're potentially looking at, 30 more years of using this bucket approach. Let's say, you're 20 years, you're in now in your 70s, and maybe you need 20 more years of it. I mean, do you allocate according to, how much time you actually think you can reasonably expect to live? Are there different ways of allocating among the three buckets, depending on what age you are?
Yes, I think that's an important point. So the size of each bucket would be dictated by spending needs. So for someone who, say, I'm thinking of my parents right now, 86
yes.
and 87, when I think about their portfolio, I'm not planning for a super long time horizon. I'm not planning for that 20-year time horizon. So we definitely have more of their portfolio in buckets 1 and 2, relatively less in stocks. So it's really important for retirees to think about their time horizons. For younger retirees, people who are in their early 60s, buckets 1 and 2 are a very small piece of the pie. The big piece is that equity piece, and that's for their later retirement years.
One of the things that you also do as the Director of Personal Finance at Morningstar is help us invest these buckets. So give us one of what your strategies would be, for instance, with your current thinking on buckets 1, 2, and 3. The kinds of
Sure.
Be more specific than just the what you just described as very broad asset classes.
Right. So bucket 1, that's the easy one. That's cash. We're not getting fancy. We're not even stepping out on the risk spectrum into, say, an ultra-short bond fund.
So money market funds, for instance, Treasury bills.
CDs, we're battening down the hatches.
Mm-hmm. And short-term CDs.
Yes, exactly. Right. So this is money we can't afford to lose because it would affect our quality of life if something happened to the market. So bucket 2, I think it makes sense to kind of stair-step this by risk level. If in a worst-case scenario, bucket 1 is all spent, you need somewhere to go for cash, that's where I would put in sort of next line reserves. And so you want to think about some kind of a high-quality short-term bond fund as maybe the first piece of bucket 2. A couple of funds I like would be T. Rowe Price short-term bond. Vanguard short-term bond index would be another good idea. I also, like Vanguard's short-term inflation-protected securities fund. And so that's the very least risky piece of bucket 2, but then I think you ought to be taking a little bit more risk with this portion of the portfolio. So from there, I would look to putting in bucket 2 a high-quality intermediate-term bond fund. I think flexibility and diversification is important, so a couple I would recommend would be Harbor Bond, that's run by the team at PIMCO. It's really a clone of PIMCO Total Return, but it's a no-load fund. I might also look to Metropolitan West Total Return Bond or Dodge & Cox Income. Again, flexible, opportunistic, core bond vehicles. I might also add a little bit of inflation protection, maybe Vanguard Inflation Protected Securities or Harbor Real Return to this portion of the portfolio.
And these are all actively managed portfolios, correct?
It's a combination. So the Vanguard short term is an index tracker,
right,
as is their inflation protected security, the short term inflation protected securities. So it's a combination. But the core funds I recommended are all active. And let me
stop you about the Harbor Bond Fund, because as you know, there's been a tremendous amount of criticism, number one, of Bill Gross and what's happened with the Total Return Fund. It's underperformed its peers and the market over the last year, and there has been a tremendous amount of money being withdrawn from those funds because of the underperformance of the last year. So, what's your view on that short-term underperformance and what's going on as far as the withdrawals? How does that affect your view of Harbor Bond Fund, for instance?
Right. Great point, Consuelo. There has been some manager turnover, not on the fund, but at the firm where Mohammed Al-Arian left the firm, and some questions about succession strategy. Bill Gross is in his 70s, so I think shareholders in any of his funds have a right to be concerned about, well, who's next in line. It's certainly a situation that we've been watching closely. I know that our analyst on the fund, Eric Jacobson, has been covering PIMCO and the fund for about a decade now, probably more. He still feels comfortable recommending the fund because of that deep bench of resources backing Bill Gross. We're not too concerned about the short-term underperformance, even though some of the calls have been off the mark recently. We still think that the resources that you get when you buy a PIMCO fund, particularly a core fund like that, are worth sticking with. We're still recommending the funds. We have a rating system for funds at Morningstar. We've still got PIMCO Total Return as well as Harbor Bond at our highest rating, which is gold. So we're still standing by our recommendations of the funds.
Great. So have we finished with bucket 2, do you think? Go ahead.
One thing I would mention would be that for the caboose of bucket 2, you might want to think about having some sort of a balanced fund, a little bit of equity exposure in this piece of the portfolio. Because when you're talking about maybe a 7-year time horizon for this piece of the portfolio, bonds' near-term prospects aren't that great. So you do want to make sure that you're adding a little bit of return potential. I would mention a couple of different products. Dodge & Cox Balanced, I think, would be a good idea here. Again, mentioning some Vanguard products, Wellington or Wellesley Income. The former is a little bit more aggressive, the latter a little bit more conservative. But you want to think about adding some equity exposure to this piece of the portfolio, too.
And it sounds as if you are investing really very conservatively in bucket 2, which actually surprises me, to hear you talk about the need for the balanced funds, I would agree with you, but if you're talking about up to a 7-year time horizon, you're investing pretty conservatively.
You are, and so this is another nod to some of the psychological forces that can be in play when people are retired. That even though certainly I think the return prospects on stocks over the next couple decades are better than what you will get from bonds. The bonds are not there as your return engine. They're there for ballast. They're there to help you have some peace of mind if we encounter some other catastrophic environment down the line. So if the equity piece of the portfolio, the bucket 3, loses 25%, well, you might look at bucket 2 and say, gosh, I lost 3% here. I can live with that. So the idea is just to add diversification to provide ballast for that equity portfolio, which is going to bob around a lot more.
And, of course, Morningstar has been doing a lot of research on behavioral finance. We've been doing a number of segments on it as well, and how we react to markets can be just as important as what is actually happening in the markets themselves. So that's probably a very good insurance policy that you're putting in place.
Well, I hope so. I think if we were all to disregard the behavioral factors, we might all have all equity portfolios if we had time horizons of 10 years or longer. In reality, people freak out when the market goes down. And so it does make sense to have those insurance policies as part of the portfolio to reduce the freak out factor.
Right. Bucket 3, tell us what specific ideas that you have that you would put in bucket 3 for that long-term growth, mostly equity portfolio.
Yes. I talk to a lot of investors who like to buy individual equities, dividend-paying equities, but here I'm thinking about a portfolio for someone where they'll live with this portfolio for many years. And as people get into their late 70s, 80s, and above, they should think about building in lower maintenance options. So I've stuck primarily with funds, with mutual funds for these bucket portfolios. You could also use exchange-traded funds. But the idea is that you're trying to get a lot of diversification with a single shot. So I have included index funds. I think you could do well with a total stock market index tracker here or a total international stock market.
So Vanguard has both of those, right?
Vanguard, or certainly some of the ETFs. Schwab has some fine ETFs now. Exchange-traded funds. Fidelity has some very good index funds. So Vanguard certainly is a leader in the indexing space, but there are other firms that are doing indexing very well. So that's one idea. You might also own some active funds in addition or perhaps instead of some of these index products. So again, coming back to Vanguard, thinking of a fund like Dividend Growth. I can recommend that one all day long because it's kind of a high-quality cut on the overall market. It excludes some of the technology stocks, tends to be light on a few other sectors, and instead biases more toward companies with a history of paying dividends. That's an easy one to recommend. Dodge & Cox Stock, another fund that I like to recommend. Fidelity Contra Fund, terrific core holding. So you're thinking about mainly large cap exposure here. You're not taking crazy amounts of risk, but you want to think about getting a lot of diversification in as few holdings as you possibly can because you don't want to have to monitor a lot of moving parts.
So, Christine, it sounds like the kind of portfolio that you've devised with this bucket approach is very balanced and also is going to perform well in very volatile markets. I know that's one of the biggest concerns that individual investors have now, having come through the financial crisis, is how to handle market volatility. But the other major concern, of course, is income, and they want to generate more income because they're not getting it from their traditional fixed income sources. How does this approach address the income issue and that need?
Well, I would say at the outset that I am a total return investor. I believe in total return investing versus anchoring strictly on current income. I like income as much as the next person, but the problem is I talk to a lot of retired investors and they show me what's in their portfolio. And in the name of income, I'm afraid that a lot of retirees have built portfolios that look pretty risky to me, that are very focused on a handful of sectors. They're venturing out to the extent that they have bonds. They're venturing out on the credit quality spectrum a little farther than makes me comfortable. So I like the idea of embedding income-producing securities within the context of a total return approach. I wrote in late 2013, this idea of seeking income was alive and well, and I was hearing from a lot of retired investors about where should I go for income. And my point was, folks, your income is hiding in plain sight. If you have equities in your portfolio, sell some stocks. Stocks gained 30% last year. That's your best income source by far, periodically lightening up when your equities have performed well. Plus, that rebalancing tends to take some risk off the table in your portfolio. So I think retirees need to change their mindsets. This incredible shrinking yield environment that we've had has, I think, called for a different approach to retirement planning. They need to not focus strictly on current income.
A contrarian approach learned through years of watching the markets and advising individuals on how to reach a more secure financial retirement. So, Christine Benz, it is such a treat to have you with us on WealthTrack. Thank you so much for your explaining the bucket approach and also for giving us some specific ideas on how to handle each of those three buckets. It's always great to talk to you.
Oh, Consuelo, it's always terrific to talk to you. Thank you so much.
Thanks so much. This has been Christine Benz, Morningstar's Director of Personal Finance on WealthTrack. Thank you so much for joining us as well.